Look at your screens. Look at the charts. We are standing at the edge of a financial precipice that most investors are completely ignoring. Welcome to the $70 silver standoff. As of this final week of March 2026, the silver market has undergone a violent transformation. Only 2 months ago, in January, we watched silver scream toward a historic high of $121 per ounce. It felt like the breakout of a century. But today, that euphoria has evaporated. We have retraced nearly 40%, landing squarely on the $70 support zone. But here is what the mainstream media won't tell you. $70 is not just technical support. It is a psychological battlefield. It is the standoff point. On one side, you have institutional short selling from bullion banks. They are desperate to keep the price suppressed to protect their derivative positions. On the other side, a massive wall of physical demand. We are seeing a tug of war between paper manipulation and physical reality, and the rope is starting to fray. Why is this happening now? Look at the calendar. Just 3 days ago, the geopolitical landscape of the Middle East shifted permanently. Saudi Arabia and the UAE signaled potential direct involvement in the Iran-Israel conflict. This is the precursor to a total energy realignment. When the desert begins to burn, the smart money moves into metals. However, silver is behaving as a geopolitical alarm. Historically, gold is the shield. It's where you hide when the world is on fire. But silver? Silver is the canary in the coal mine. It sits at the intersection of industrial survival and monetary collapse. If silver holds $60, industry is still betting on a future. If it breaks, it warns of systemic hyperinflation, where the paper price and physical price will decouple forever. The warning is clear. The chaos in the Middle East is a signal that the old world order, the one built on cheap energy and stable supply chains, is dead. As we sit at this $70 floor, you have to ask yourself, is this a temporary dip or the final chance to exit? We are seeing the largest drain of physical silver vaults in London and New York in over 50 years. The warehouses are emptying. In the next 12 minutes, we dive into the meat grinder of the Middle East energy crisis and the death of the COMEX. The $70 standoff is a countdown to a 3-digit silver reality. This is not just a trade, it's a warning about survival. Pay attention, because the floor is about to become the ceiling for everyone who waited too long. To understand why silver is stuck at $70, you have to look at the meat grinder currently churning in the Middle East. We are witnessing a total decoupling of the traditional energy to metal correlation. As of late March 2026, crude oil has surged over 40%. Brent crude has officially crossed the $100 per barrel mark, and it shows no signs of cooling down. Usually, when energy costs explode, silver follows as an inflation hedge. But right now, we are trapped in a liquidity paradox. Think of the global financial markets as a giant engine that is running out of oil. When the price of crude spikes to $105, it creates a massive margin call on Wall Street. The institutional trading desks are losing billions. To cover those losses and stay solvent, they have to sell what they can, not what they want. They are dumping their silver paper contracts to raise cash. This is why you see silver at $70 while the world is literally on fire. It is an artificial suppression caused by a desperate hunt for liquidity. But the real story is about the Strait of Hormuz factor. This narrow waterway is the jugular vein of the global economy. 20% of all global oil and gas flows through that point. With the recent escalation between Iran and the surrounding coalition, the threat of a total blockade is now a 50-50 probability. If that gate closes, the energy crisis transforms into a silver processing crisis. Silver is a byproduct of industrial mining and refining. Most silver is refined alongside copper, lead, and zinc. Those refineries require massive amounts of cheap energy to operate. When energy costs quadruple, the cost to produce an ounce of silver doesn't just go up, the production stops entirely. We are looking at a scenario where the supply side of silver is being throttled by the very war that should drive its price higher. The Middle East chaos is screaming at us. It is telling us that the just-in-time supply chain for silver is failing. Logistics for moving bullion are being redirected or insured at rates 500% higher than they were last year. The actual cost of moving 10,000 ounces from London to Munich or Delhi is skyrocketing, while paper silver stays at $70. The standoff at $70 is a temporary illusion. It is the calm before the physical shortage hits the industrial sector. The Middle East meat grinder is chewing up paper shorts. Very soon, there will be no more metal left to deliver at these prices. If you're waiting for $60, you are missing the fact that the physical market is already trading in a different universe. Welcome to the graveyard of the legacy financial system. If you want to know why $70 is the line of death for the big banks, you have to look at what happened on March 1st, 2026. We witnessed a liquidity trap that almost broke the global plumbing of the market. A single sell order, totaling 159 million ounces of paper silver, was dumped onto the COMEX in less than 4 minutes. To put that into perspective, that is nearly 20% of the entire world's annual silver mine production, sold in the blink of an eye. The result? An immediate trading halt. This wasn't a market reacting to news, it was a desperate attempt to stop a short squeeze. That would have sent silver to $200 overnight. This is the death of the paper market. The price you see on your phone at $70 is a fiction, a digital mirage created by banks trading ounces that do not exist. For every 1 ounce of physical silver in a vault, there are now estimated to be over 400 ounces of paper claims circulating. This brings us to the great disconnect. While New York and London try to pin the price at $70, the real world is revolting. Look at the physical premiums in India, specifically in Chennai and Hyderabad. Physical silver bars are trading at 300,000 rupees per kilogram. When you do the math, the real world price of silver in the East is already pushing $85 to $90 per ounce. The smart money has already begun its exit. We are seeing a massive migration of metal from west to east. Since the Middle East conflict intensified, institutional investors have been using retail buy the dip sentiment as their exit liquidity for paper contracts, while simultaneously taking delivery of every physical bar they can find. The central banks aren't just watching this, they are participating. They are quietly hoarding silver alongside gold because they know the paper game has reached its mathematical limit. Why does this matter to you? Because when the paper market finally dies, it won't be a slow decline, it will be a gap up. Imagine waking up and seeing silver at $70 on COMEX, but your local coin shop is asking $140. That is the $70 standoff. It is a fake price designed to keep you from taking delivery of the one asset that can't be printed. The standoff is a ticking time bomb. The banks are trapped. If they let the price rise, they go insolvent on their short positions. If they push it too low, the physical market gets drained even faster. They are stuck at $70, praying for a miracle. The paper market is a ghost ship, and the icebergs are closing in. While the Middle East is the immediate trigger for this $70 standoff, there's a silent, structural war happening in the background. It has nothing to do with missiles and everything to do with the future of human civilization. We are currently in a massive global deficit. Since 2021, the cumulative shortfall between what we mine and what we consume has reached a staggering 820 million ounces. This isn't just a market dip, it is a mathematical collision course. The world is building a digital utopia on a foundation of disappearing metal. Think about the massive data centers being constructed across Northern Virginia and the Middle East to power the next generation of artificial intelligence. Every single one of those servers, every high-speed connection, and every liquid cooling system relies on the superior conductivity of silver. AI isn't just code, it is silver and electricity. As we move into 2026, the AI arms race is colliding with the energy transition. Look at the solar industry. Despite the economic slowdown in the West, solar installations in the East have surpassed even the most aggressive projections. N-type solar cells are becoming the industry standard, and these cells require significantly more silver paste per watt than the older models. The industrial sector's demand for silver is non-negotiable. Tech giants like Apple or Tesla cannot wait for the Middle East to stabilize. They have to secure it now, at any cost, to keep their assembly lines moving. This creates a deficit that the paper price ignores. We are watching a scenario where industrial users are stepping over retail investors to secure long-term supply contracts directly with miners. They are bypassing the COMEX and the London bullion market entirely. When big tech realizes the physical shortage, they will buy the entire warehouse. This is why major investment banks like Bank of America and Citigroup are still maintaining their ultra-bullish outlooks despite current volatility. Internal models are eyeing a move toward $100 or even $300 per ounce before the end of the decade. They know that you cannot print a solar panel or digitize an AI server without physical silver. It is a material reality. The standoff at $70 is the last moment of price discovery before we enter a price delivery phase. In a world of war and high-tech competition, silver is no longer a luxury. It is a strategic necessity for global powers. The Middle East chaos is the spark, but the AI and energy revolution is the fuel that will blow the roof off the ceiling. If you think $70 is expensive, wait until tech giants start competing with central banks for the last remaining ounces. As we stand here in late March 2026, we have to address the elephant in the room, the Federal Reserve. The higher for longer interest rate policy is the ultimate trap for the silver investor. The Fed has officially taken rate cuts off the table for the remainder of 2026, creating a strong dollar headwind. This is fighting the war premium of silver every single day. This friction created the $70 standoff. But the Fed is playing a dangerous game. By keeping rates high to fight inflation, they are essentially bankrupting the U.S. government via interest payments on the national debt. The national debt has now crossed $38 trillion. This leads us to the final warning. The dollar is strong only because everything else is perceived as weaker. But as the Middle East chaos deepens, the petrodollar system is dissolving. When Saudi Arabia and the United Arab Emirates move closer to the BRICS alliance, the strong dollar narrative becomes a house of cards. Silver at $70 is the last gift for those who understand that a currency is only as strong as the energy that backs it. So, where do we go from here? There are three distinct scenarios for the remainder of 2026. The first is the bear case. If we see a temporary de-escalation in the Middle East, silver could briefly break below $70. This would be a flush out of weak hands. The second is the base case, a long grinding consolidation between $70 and $95. The third scenario is the moonshot. If an Iranian escalation leads to a total closure of the Strait of Hormuz, the logistical chain will snap. We are looking at a parabolic move past $150 as the paper market defaults. Our strategy is simple. Do not panic sell. This is the time for dollar cost averaging. The $70 standoff is the final siren before the real move begins. History shows that when the canary in the coal mine stops singing, it's time to leave the mine. Silver is singing right now. Will you be holding a piece of the future, or will you be left holding a handful of paper? Thank you for watching. Hit the like button and subscribe for our next update on the global metal markets. Stay vigilant.